Thank you guys for tuning in. Really appreciate you being here. My name is Chad Prinkey. I am the founder and CEO of Well Built Construction Consulting and the host of the Well Built podcast. This is a kind of a cool first time thing that we're doing where we're recording this live with an audience in kind of webinar format, and we'll also be turning this into an episode on our podcast. So the people who are here live have the benefit that those of you who are listening on Apple or Spotify don't, in that you can ask questions as you're getting an opportunity to engage. So please use the Q&A box. We will monitor that through the course of the program here and catch people up. So today's session is building an exit, securing a legacy, how ESOPs can solve for ownership succession for construction companies. And with me, I have my friends and really, really smart guys, Roger Feldman, who is a financial advisor at UBS Financial Services. And you might be asking yourself, what's a financial advisor know about ESOPs? Well, Roger's whole game, really, like his expertise, is helping owners to make the most of their ESOP, wealth and setting those things up. So I'll let Roger describe more on his own. But Roger, thank you so much for being with us.
Absolutely.
Yep, and we also have Ethan Stambler. And Ethan is a senior vice president at SES ESOP Strategies, which is an ESOP, kind of soup to nuts firm that helps companies to make that conversion to an ESOP, helps them to evaluate it. And Ethan's like, I don't know, I would probably describe my perspective is a client advocate and partner. He does an excellent job of talking to folks about whether they ought to do an ESOP. Super high integrity people, both Ethan and Roger, which is why I had him on here today. No pitch, just great stuff. So Ethan, thank you for being with us too.
Thanks, Chuck.
Yeah, no, it's an honor to have both of you on the show / webinar here with me. I'm gonna dive in a little bit into some questions. But before I do, Roger, I'll start with you and then I'll go to Ethan. Maybe do a little better than I did in terms of intro, just for context of exactly what you do, what your expertise is in this world, type of thing. And then I'll ask you to do the same, Ethan.
Chad, thank you very much. So good morning, all. My name is Roger Feldman. I'm with UBS Financial Services based in Baltimore, Maryland. I'm a part of the Anchor Wealth Management team. My focus has really been working with owners of construction companies since the early 90s. I initially started working with construction owners from the perspective of their retirement plans, and from there it morphed into succession plans. And it was a natural progression and really germane to our conversation today, because a business owner has, particularly in the construction space, about 80% of their net worth tied up in their business, right? And the same business owner is anticipating the sale, the monetization of their business to fund the majority of their retirement. So how do they do that? And that's why we're here. So just to take another second in that regard, we help business owners solve for, along with Ethan, along with Chad, along with your whole ecosystem of trusted advisors, but we help business owners solve for their wealth gap. That is, how do they take their current assets, their investable assets, the value of their company, and what do they need in retirement? That's
Right.
what it's all about. It's about building a plan. And in the plan, we talk about the 3 Ls: your liquidity, which is your short-term needs; your longevity, which is your 3, 5, 10-year needs in retirement; and then your legacy. So we help solve for the 3 Ls, and we have found that the ESOP is very viable exit strategy, particularly in the construction space.
Wonderful. Yeah. And thank you for particularly highlighting there, Roger, your deep personal background and experience in construction for decades, working with construction owners. And I know the same is true for you, Ethan, but talk a little bit about, fill in the gaps that I may have left when I introduced you.
Yeah, sure. No, thanks, Chad. And picking up where Roger left off on, obviously the ESOP can be a really effective financial solution particularly for construction firm owners. And that's where our firm is really focused on helping to ensure that, one, more companies recognize that it may be the right solution for them. There's just a lack of awareness in the market, which we spend a lot of time, well, sure, along with Roger and his colleagues, helping to address. And really, ultimately, the ESOP allows for a combination of both financial objectives be achieved, as Roger suggested, but also non-financial in some really unique ways. And I'm sure we'll get into that in terms of the owner's desire to achieve, in addition to liquidity and the long-term financial piece, control around their own exit from the business from a leadership and management standpoint, and ultimately the legacy they leave in the business and for all its employees.
Awesome. Awesome. All right, cool. So I don't want to take anything for granted that our audience knows what an ESOP is, even, right? So it stands for an employee stock ownership program. And we're basically going to go through three main sort of high level questions with a lot of smaller questions in there. Where first we're going to talk about, what it is and why we should do it, why we should consider it, right? Then get into the mechanics and structure of how it works. How does an ESOP work? And that's where I'm really hoping that our audience, our live audience, types in questions and gives us a chance to address, what may be going on in their minds. And folks, I will keep your name out of the show, by the way, right? So not everybody will know who the question's coming from if you don't want this to reach thousands of ears, right? So we could do that. And then the last is, why wouldn't I do it? What are the preventative circumstances that we should also be aware of as we go? Along those lines, I think just the first question that I'm going to pose, and I'm going to bring it to you, Ethan, is, can you describe to us in like a minute or less, what is an ESOP?
Sure. Yeah. So an ESOP, so ESOP stands for Employee Stock Ownership Plan. And so it is a mechanism effectively for the business to buy out the owner, with the ownership of the business eventually transferring to the employees that work within that business, broadly speaking. And so this is not, it's not an individual transfer to one or two individuals. It is a transition in ownership to the broad base of employees that really run it, that are involved in that business. And importantly, it's a mechanism for them to do that without the employees having to come cash out of pocket to actually acquire the business. It is
Right.
set up as a retirement benefit. So importantly, what the employees are earning over time are the shares in that business. And so those accrue to them just, in addition to other retirement benefits they might have, to really build wealth and ultimately participate in the value they're creating within the business.
Outstanding. No, good. Yeah, great rundown. And I think as you guys know, we work with, all these contractors. I've worked with hundreds of contractors, and a lot of them will say something along the lines of, I want my people to buy this company from me, but they just don't have the money. Like, so I've got to finance it, and this, that, and the, so if you're of that mind that you'd like to find a way for your employees to own the company, this is an extremely, now it would be the broad base to Ethan's point, but this is an extremely viable option. You guys have seen a ton of these ESOPs and helped to design them and help to capitalize on the benefits of them and all those types. Roger, simply put, if you had to pull the top three, and I bet you there's 100 in your mind, but the top three benefits of putting together an ESOP, what would you say they are, Roger?
So, Chad, I want to break this down in a couple, I guess, lanes, right? So there's the advantage to the owner, right? The selling shareholder. It can be structured in such a way that it's tax deferred and maybe tax free, depending how it's structured. That's to the owner. As far as to the company, as far as the company is concerned, some really big advantages. And now I'm going to go to like the qualitative component of an ESOP. So ESOPs, we find the voluntary quit rate by ESOPs employees are roughly a third of the national average. Right. We've also found that there's a higher job retention rate, higher pay, workplace health safety. It's a great benefit to the company. It helps solve the labor shortage, right? That's one of the biggest concerns in the construction world right now is who's going to man the job. And then as far as, I'm sorry, that's the company's advantage, right? And also it can be structured in a way where the company doesn't pay taxes. And then now back to the individual, like Ethan said earlier, this runs concurrently to your 401k. So it's with no money up front. Your floor cost as an employee of an ESOP for your phantom shares in the ESOP is zero. You have nothing to lose. It gives you a chance to create wealth in a way that is really, it costs you nothing.
All right, outstanding. So we've got employee retention, we've got tax advantages, and we've got the ability to create a lot of wealth for employees. Ethan, what would you, if you had to do another short list on top of that, what would you stack on?
Yeah, I would actually, speaking to the non-financial piece of it, provides the owner an incredible amount of control over the transition process, right? So in contrast to other, situations you were selling out to, another party, whether that be an investor or a competitor or somebody else, the ESOP allows for a whole range of options. You can sell a portion of the business, you can sell a minority stake in the business to the ESOP and retain a majority control. You can sell 100% of the business. You can stage it, sell a minority stake and later sell 100%. If you have different partners, your stakeholders within the business, maybe different family members with different time horizons or different goals, again, the ESOP can be structured. And this is, we spend time helping to really dial in the specific objectives for the business owner or owners as to what they're achieving. And it allows them to come up with really a custom created exit plan for them that addresses both the liquidity and their own personal, objectives in terms of their time in the business and how they're doing it. So I would certainly add that to the mix.
Outstanding. All right. I love it. And there, I'll add one just to stack on top of everything that you guys have talked about from a very practical and financial standpoint, as well as a peace of mind and control and those types of things. It's also a feel good. It really is. I mean, there are a lot of ways to exit your business. This is one that is going to feel an awful lot like a gift while still having a lot of financial benefits, right? So you're not giving the company to your employees. You are going to make money from this whole experience, but goodness, you're also going to help a lot of people in the process. And Roger, in the preparation for this show, we were talking about success stories and where we've seen this work. You and I have a common friend, and I don't know if you think he'd feel comfortable with
Oh,
you calling him
absolutely.
out, but I'd like for you to share actually what our good buddy Russell shared with you.
So we did an article for one of the trades magazines, and they said, please go get a quote from someone involved in an ESOP. And from Russell Tipton from Harkins Construction made the comment, the best thing our benefactor, our founder ever did was form an ESOP. Those of us that have been here since inception, we are now all millionaires. And he's the
Yeah.
ESOP trustee. Yeah, it's just brilliant. Yeah.
Yeah, and we're not. By the way, Russell Tipton's probably 40, right? Like
Right.
he's not 65, so it doesn't take that long to become a millionaire, in a really well run business, type of things, which Harkins Builder certainly is. But yeah, so all right, it's there's a lot of reasons why we should do it, but there's also a whole lot to understand. So I want to get into some of the mechanics of how the thing actually works. So I want to start first with the tax piece, just for clarity and understanding. We hear a lot of this like, well, it's tax free or tax deferred, and so I don't. Maybe Ethan, you can take this on.
Sure.
Describe for us exactly the tax advantage in as simple terms as you can.
Yeah. So really, there are three real tax benefits to it. At the first, I'd starting with the business owner, right, as seller. And as Roger alluded to, they have added ESOPs have been around for decades. Primarily, the only changes they've made to the regulations are to provide additional tax incentives to encourage business owners to head this route, with incredible bipartisan support, frankly, over the decades for that. And so they've added these in over time. On the seller side, there there's the opportunity for the seller to defer and effectively indefinitely defer paying any capital gain tax on the sale of the business. And so again, often these are businesses that have been built, they may be multi-generational family businesses or, established by a founder years and years ago, generally a low cost basis, not insignificant capital gain tax due on a sale under most exits, right? And that could be, depending on your state, 20+%, right? 20 to 30%. And so there's the opportunity. I won't get into the detail of it too much, but in effect, it's corollary to a 1031 exchange in real estate, where effectively you can reinvest the proceeds from the sale in broadly defined investments, which the basis carries over to. So no tax is due until those new assets are actually sold, and those can be a wide range of securities. So
Wow.
that's one big benefit, which on an after-tax
Okay,
basis
so
is really
simple terms, if I'm an owner, I can experience this exit and not owe capital gains taxes, period.
Correct.
Right? Like, and that's unbelievably valuable for owners. Okay, you
Okay.
say you have two more.
Number two, for the company, right? As the company is contributing money to the ESOP to actually fund its purchase of the shares, all of those contributions are tax deductible to the company. So if it's a C corp, those are all deductible, and so effectively, it's both the principal and the interest on the transaction that can be deductible for the company. So that itself creates an additional tax shield. Ultimately, the benefit for the company is to become an S corporation. Because if you have an S corporation that is 100% owned by an ESOP, that ESOP, remember, it's a retirement account. Just like you don't pay taxes year to year on whatever's happening inside your 401k or your IRA, that retirement account, the ESOP, does not have to pay any taxes. So it's the owner of a for-profit business that would normally be passing its profits back to to its owners, who would then have to pay tax on it each year under very specific, rules set up just to benefit ESOPs. ESOPs don't have to pay any tax. So ultimately, you have a very profitable company that has no current tax liability from an income standpoint at the federal level and generally at the state level as well, which allows the business to just retain an incredible, additional amount of capital within the business to fund growth and ultimately fund the reward to the employees that are going to be building value over time.
Yeah, and I think that's one of the most spectacular aspects about it. So that if on average, just using a round number, a company has to pay 40% of its profits, right? Whatever net profits they have at the end of the year, they have to pay taxes on 40% of that. That goes to zero in an ESOP.
Correct.
That's
Correct.
at the state and federal level. No taxes paid anywhere.
Yeah. I mean, generally, the state follows the federal treatment on that. And so nothing due.
Amazing. And to your point, but broad bipartisan support has allowed that to happen, which is also a good sign, right? That there's
Yes.
nobody currently lobbying to change that, right? Or I shouldn't say nobody. I'm sure there are some people, right?
Yeah.
But like this is not a political hot potato.
No, no, and I'm a contrary. The legislation that's pending out there is only additional sweeteners, frankly, and support for ESOPs. So the
Outstanding.
outlook is good.
Spectacular. Okay, good. So that helps on the tax side of things. Next question. How does the value get determined in this scenario? And how does that compare with if I were actually shopping my company, for example, to a strategic buyer or a private equity buyer?
Sure.
I'll keep that with you, Ethan.
Yeah, no, I can take it, and it's certainly one of the things we work through with folks through the process. So ultimately, the ESOP can acquire the business at fair market value. That's basically what the regulations say. And that fair market value is determined through the same kind of an analysis that anyone valuing a business would typically apply to it. It's going to be looking at a combination of its forward projected profits, obviously informed by its historical profitability. It'll be looking at things like its asset value, and then on a blended basis through different valuation methodologies, they'll come up, we'll, as an advisor to the business, will come up with a range of value that's relatively tight as to where we believe fair market value sits for the business. Now, what's interesting in ESOPs relative to other transactions is the ultimate price is determined through a negotiation with a trustee that is brought in for the transaction. That trustee is selected by the business owner. So it's a really unique mechanism where a business owner is going to sell their business. They're effectively choosing and hiring effectively the buyer for that business that's going to become the counterparty. But again, these are all trustees that are well versed in this space that we know well, that we're bringing into the process for them to choose from. And ultimately, that trustee will settle on the value for the business. But again, it's going to be based on the fair market value as any objective person outside would determine it. Now, what it doesn't include, relative to an outside buyer. So if you have, private equity can be very aggressive buying up, contracting businesses in particular, and particularly, other trades. When they're rolling those up, they're factoring in additional cost savings that they're going to expect through perhaps consolidating operations or, additional growth that they believe over time, we'll see if it happens, that they can bring to the company, right? And so they'd be willing to pay some premium perhaps right, for that additional value. That's not additional value that the ESOP can provide because the ESOP ultimately is buying the business with the whole point of continuing to run it, and it'll continue to grow and thrive, but it's going to be running it on a standalone basis as it currently is. And so that's where you'll have some difference. But again, the tax benefits up front can help to close that gap on the margin. So even if a private equity buyer is looking extremely aggressively at a business, they'd still have to exceed that potential, 20 to 30% after tax benefit that you'd get on the ESOP.
Chad, can I expand on that for a second?
Sure.
So,
Sure.
so to Ethan's point, as you're running perhaps this dual track analysis, if you want to look at private equity or selling to a competitor, which we call a financial buyer or strategic buyer, as you're running this dual track analysis, you've already created a buyer, you yourself, the company. So you've created competitive tension from day one.
Yeah. Yeah. Makes total sense. Yeah. That's so okay. I just want to, Ethan, if I can come back to you
Sure.
for just a quick clarifier. You talk about this negotiation phase. Step by step here, am I correct to assume that step one, there will be an outside third party evaluator that will place, a professional valuation expert that will place a value on the business? Step two, there will be a negotiation between that entity and my trustee that is appointed by me as the
Right.
owner to hash out exactly what the value is going to be. Is that third party? Is that first off, is
Yeah.
that right? And second off, assuming it is that third party evaluator appointed by a bank?
Yeah, so to clarify, that initial valuation, right, the initial range of value is actually something that we work on with the business owner, right, as our client. So we're helping to identify where we believe fair value for
Got
this
it.
business resides. It ultimately is actually the trust. The next step is we would help the business owner to select a trustee. Okay. That trustee is going to hire its own valuation agent. That's who's actually hiring a third party valuation agent who's going to advise the trustee on what they believe fair value for the business is. And again, we're, the ESOP trustee, the fiduciary who's looking out for the interests of the employees and the participants. So ultimately, it's them that need to agree and agree to the final value, and they're going to
Got
have their own advisors on the outside doing that. But one of the things we're doing early on is helping the business owner to understand with pretty good clarity
yeah.
where that range of value is going to be,
Yep.
and with very high reliability, we ultimately have a history of settling
Yep.
narrowly within that range.
Makes total sense. Okay, so Roger, let's talk money. For with the owner here. How are these deals structured? How quickly does an owner get their money? How much money do they get? In what order? I'm sure there are different flavors. I know for a fact that there are different, flavors of this, type of thing. But like, if somebody is listening to this and, basically trying to evaluate, like, how much money am I going to get out of this? Let's say my business is valued at 10 million through this exercise that Ethan just went through. How fast do I get my 10 million, and how does all that work, Roger?
Sure. So it's kind of like two questions within with the same vein. And I want to start with an overarching statement. If you think an ESOP is your automatic exit where you will receive a large chunk of money and walk away from the company tomorrow, it's not for you. If you have a 4 to 7 year traditionally horizon to reap the benefits of selling as being the selling shareholder to the ESOP on an after-tax basis, if you have that longer term timeline, you're a very good candidate for it, right? So the company borrows money from the bank. It
Okay.
immediately the bank now puts the money with the ESOP, right? The ESOP buys shares from the selling shareholder, right? The selling shareholder has to be willing to put on debt. If you have a company that you can't handle additional debt, you're not a good candidate. If you have a company that really leadership wants to walk away the next day, you're not a good candidate. So over the course of time, and so from the perspective of the employees for a second, you're part of a successful ESOP, you may not see a thing for a year, right? It may take some time until shares are allocated and they're all done in like a non-discriminatory basis. So there may be, please have a realistic expectation as the employee when you'll see the benefit. So now the company, right, has to pay back to the bank, right, these monies, right, and also because the selling shareholder has taken on debt. So the company is in a position where the bank has to be paid off, and then eventually the selling shareholder has to be paid off. But because the company operates in a tax-free environment, right? Remember, it's now owned by a retirement system. That's where you get the acceleration. As far as the owner's concerned, he receives a premium, ideally relative to market rates, because has lent a subordinated debt. So let's go back to let's make it $10, right? So if the enterprise value is $10 after taxes, right, you may wind up with $7.50, right, or to add zeros, right? But in the
Sure.
same token, if you've gone through the whole process and you did a 100% ESOP, at the end of 4 to 7 years, your return may be $12.50. So in
Uh-huh.
other words, there's a premium that you get for your time frame. So if you're looking for an immediate out, it's not for you. If you're looking for, but I want to take it to so now the participants have all this time. They have this, we're in it to win it. There's a people first, persona for the company. Everybody's an owner as far as is a leader, but everyone shares in the participation. So you see it's beneficial to them. Let's go back to the owner for a second. It can be structured Ethan can structure this in such a way, he and his team, that when the owner dies, what he still owns, right, because of a step up in basis, his family doesn't pay taxes on what they inherit. So you see kind of the whole path there.
Yeah. And so Ethan, I can tell you want to stack on top of that a little bit. And if you can, when you're answering, I'd like to just really, going back to my $10 million example, how
Sure.
much of that am I going to get now? How much am
Yeah.
I going to have to wait for? What's typical?
Yeah, yeah. So, and I'll address that in a second. And what Ryder's alluding to, yeah, for somebody who wants to cash out and never see their business again, an ESOP is not the right answer, right? What it does, and what Roger's alluding to, is it allows the business owner to separate the question of economic ownership of the business from management of the business, and that allows for whatever time frame makes sense, but comes with a time frame around getting the liquidity as well, right? Ultimately, what that looks like from a dollars and cents standpoint, it all depends on the business and the industry and everything else. But generally speaking, right, banks are willing to lend somewhere between 20 and 40%, right, of the value of the business up front, where they can actually get. And so that immediate liquidity that initially goes to money that's lent to the company, which is then lent to the ESOP, which is then used to buy the shares from the business owner, can be immediate liquidity that they would receive. Right. The balance is typically the seller financing that Roger was alluding to. And so that, call it, significant amount, be 60, 70%, is going to be paid off over time through the profits of the business. But again, generally often on an accelerated basis, particularly once the S corporation tax benefits kick in and create that, 100% tax shield there. And so that's the general timeline for it. Often what happens is, that the bank debt gets paid down more quickly than it frankly needs to get paid down often. And at that point, banks who are in the business of making loans are happy to effectively re-up that loan, which then provides for another slug of liquidity to come through. So it's, again, overall, it's going to be, we'll call it 5 to 7 years, but with a significant portion up front, and then the rest coming, in sort of potentially tranches or steadily after that.
Awesome.
Yeah.
Awesome. And would it be right to assume that the company's performance will accelerate or slow down how long it takes for me to get my money if I'm the owner?
It will in a couple ways. And one thing I'd say, and particularly this is true, to be transparent about it, in the construction space, depending on, the nature of the specific, um, sector that the business is in. If it's a GC that where revenue and profitability can be pretty lumpy, right? That's going to reduce the amount of perhaps bank lending that's available immediately up
Right.
front, and might require a greater level of seller financing. But again, that's something that we can work through and ultimately sort of optimize for. The performance of the business itself, ultimately, and ability to deliver on what everyone expects, is certainly going to impact things. But generally speaking, it's being paid down on. We structure these to be sustainable, right, and to achieve the outcomes that we've designed for on the front end. So it's not like you're waiting for sort of a profit share each year that's going to vary depending on what's happening. I mean, as long as the business is performing within the range that we expected it to perform, it's going to be paid out on a steady, predictable basis, with potential accelerations coming from time to time, as we talked about as well. And one thing I'll add, Chad, is, and Roger alluded to this too, there's a return on that subordinated debt on the seller financing that ultimately is additional proceeds for the seller, but also, and this is, particularly for the business owner that's continuing to run the business while this whole process is playing out, they're participating in the upside of that business through a couple mechanisms tied to that debt, which actually gives them a potential participation beyond just the interest on the loan. They'll actually get an additional payout on the debt tied to the value of the business, and other mechanisms we can build in. So that also can be significant and change the outcome for folks from a liquidity standpoint.
Awesome. Okay, that makes sense. And so and I'll just take this to an extreme, and I don't, if the company really struggles and is not being profitable, and it's wrestling through, right? Like, is there a, let's say, I'm again, an extreme. Let's say it's 10 years on, we have not made money as a business, right? We're not making a profit. Does this thing eventually sunset, or does it just take 30 years to pay you, right? Like, does
Yeah.
it ever kind of go to where, sorry, bud, you're not going to get any money out of this?
Yeah, I mean, so look, conceivably, it would extend on it. Look,
So it
it,
doesn't,
it
it
would
doesn't,
extend on if a business owner, right? I mean, one of the things I frankly love about what we do is that these are wonderful businesses, and they're really great business owners that care about those businesses. And so, that goes into structuring the thing up front so that we're not putting the business in a position where we believe, there's stress necessarily that's going to happen. That said, things happen, right? Things go sideways, markets turn. There certainly are situations where everyone rightfully expects the debt to be able to be paid off over time, over a set period, and for some reason it doesn't. Then it becomes a question, I mean, obviously the banks need to get paid, right? And that's why they're first in line. But the question then and they're going to always require coverage ratios and things to have comfort that the business, even with a downturn, is going to be able to cover this debt over, typically those loans are structured to have a 5 to 7 year payout even to the bank, even though they generally can get paid back much more quickly. So there is room there. And then ultimately for the seller, it's going to become a question of a negotiation and what they're willing to sort of forego and adjust for the benefit of the business. And again, given the nature of these business owners and why they're doing this in the first place, it provides, you generally provides them the flexibility to adjust if they need to, as opposed to what a, financial investment buyer would do, right, if faced with that same situation.
so let's take a scenario where I'm a business owner that has done an excellent job of ensuring that the business already runs really well without me,
Mhm.
right? It's not owner operated anymore, right? It's operated by my leadership team, and I'm barely involved. Is switching to an ESOP going to increase in any way my need for involvement in the business? Is somebody going to make me go back to work? Right? Or something along those
Right,
lines,
right.
right? If I'm already sitting on a beach most of my time enjoying the benefits of this really well-run business that I've created, is switching to an ESOP in any way going to make my life more difficult? I'll steer that one to Roger.
I don't believe so in any way. I think one of the things that just we can do background to how you got to that question, Chad, is we're finding that service-oriented construction firms are good candidates for ESOPs, whereas, build to complete, not necessarily so much so. So depending what your specialty is, and you've done all the right things where the business is not so totally dependent upon you. The majority of your revenue doesn't come from, two or three of your clients. No, the answer is no, but you still have control as much as you want of the company based on the fact that there's the board that you'll have a board, and then there's also the people that you put on the board for the ESOP. So you can be as involved as you want or not. And then another thought is ESOPs get sold, right? So you certainly want to play. We're back to the legacy now, right? In the three L's. So what type of legacy are you leaving? And you'd certainly want to play a role if that were to be a scenario were to pop up.
Yeah. Yeah, agreed. So I want to get to governance here, because we've been talking about trustees. We talked you just mentioned boards. How does this and you mentioned earlier, Ethan, that I'm going to maintain a lot of control as an owner. Describe to me how how an ESOP is governed. What's the corporate governance look like? What does the authority look like, inside this new entity that we've created?
Right. Yeah, so in most instances, management does not change, right? In terms of the business, whether that's the current owner operator or a great management team that they've built underneath them and been able to relinquish control to. So generally speaking, that's, management team is going to stay in place. What's going to be new is that potentially, right, is that that management team is actually going to be overseen by a board of directors. That board of directors, if it already, may already exist, depending on sort of formality of how the business is run, or it may not, it may informally exist. But formally, once the ESOP is established, a board will be established with designated board members. That board typically consists of the existing folks that are largely running that business, right? So it's going to be the owner operator and or others and others involved with the business. With the addition, definitely, we certainly believe from a best practices standpoint, it's good to add at least one or two independent directors to that board. But again, those independent directors are going to be proposed by the existing ownership and
Right.
management team,
Okay,
right?
got
So
it.
it's not the trustee,
It's not the
introducing folks saying,
trustee, it's not the
here
bank.
here's
Yeah,
your new board member. Hope you get along. It's the existing ownership of that, and management of that business with their, informing it as to those board members are going to be. And those board members must ultimately be approved by the trustee, or at least voted on by the trustee. Now, if it's a minority sale of the business to the ESOP, they're going to have a minority voting position on those board members. If it's 100% owned by the ESOP, they will control all the votes on the appointment of those directors. But importantly, the trustee is looking out for the employees effectively as a passive investor in the business. They are not looking to be actively involved, and so they're going to want to make sure that there's good, credible, value-added board members that are sitting there, and that's what they're looking for. And then the
got it.
trustee is sitting at the top from a governance standpoint, really only involved in a few things. One, very importantly, involved in approving the terms of the initial sale of the business, as I alluded to earlier. And then going forward, their responsibilities are important but relatively narrow. They're going to be responsible for approving an annual valuation that's done each year on the business, both just for the employees and the shares that are moving around. And then ultimately, long term, if there were decisions to be made about selling the business or something like that, large corporate kind of life cycle events, then again, as a voting shareholder, they would ultimately, have some say over those things. But day to day, in terms of running of the business, they're not involved and they're not looking to be involved. That's not their role.
Got it.
So.
Okay, we have an audience question that I'm going to steer to you, Roger. How is it determined what portion of ownership each employee receives? And, assuming senior management, for example, is going to receive more ownership than a warehouse employee.
So you cannot discriminate, much like in a 401k. So you're highly, of course, there's parameters you can put in, the numbers of hours of service before you're eligible for it, or to participate. But essentially, the highest compensated and then the lowest compensated is proportional. You cannot favor one over another.
Okay, got it. So if I'm understanding you right, you're saying how many shares a person receive is directly correlated with their salary.
Yeah.
Is that total comps or just salary? Is that like total comp including bonuses?
It would be a total W-2 earnings, basically, is what it
Okay,
comes
cool.
down
So
to.
total comp.
Right, total comp, and it has to be formulaic, is what it's another way of saying non-discriminatory. So somebody that makes $100,000 in a year in total W-2 wages is going to get twice the allocation of shares in that year as somebody that makes $50,000. That's basically how it works. There are, and that's the primary driver in how these things are done. There are additional things we can build in, and we do sometimes build in where you can provide within the formula some additional credit for folks based on the number of years that they've been with the
Ah,
organization. So if you have two people both making $50,000 a year, but one has been there for 15 years and one just joined last year, the formula can be tweaked so that you're giving them credit for a little bit additional weight for having been there. And I frankly like to see things like that just because I think it helps to even further align things and helps to build on, the reward and build on the retention that the ESOP can also drive.
makes sense. I've had people tell me in the past, guys, that I looked into an ESOP. It's just too expensive. Is there any credence to that thought, and how expensive is it going to be for me to set up my ESOP, Roger?
Well, it all depends on the valuation of the company for starters and what type of ESOP you want to do. There are some continuing expenses that you wouldn't incur if you sold to a strategic or, competitor or financial or private equity. You have to have an ESOP and you have a third party administrator, right? You have to have the annual valuation. But net, it works out if you take into the after tax, long term horizon. Net, I believe you wind up ahead, or maybe it's a, it's it kind of washes out. But we do think, right? We do think that there's a lot to be said for when you do your initial analysis of which path you want to take, that you factor all this in at one time.
Yeah. Ethan, your take?
Yeah, I mean, two things. So on the long term, I'd actually be a little more definitive about it. Yeah, people say there are expenses that a business will carry going forward as an ESOP that it would not have on its own, and those will be some tens of thousands of dollars likely, per year. On the other hand, think about giving up your annual income tax bill. Right, on a business generating,
A
two, three,
million
four,
dollars in profit?
$5 million a
Right.
year in profit, and you're not paying, 30-40% of that in tax, you will more than cover, I'll take that bet any day. You will more than cover the $30,000 or $50,000 that you might be spending on annual valuations and trustees and things like that.
What
Um,
about the
uh,
setup of the ESOP
yeah,
itself?
and
So
setup
is that going to be?
the setup in the ESOP itself, what I tell people is, look, in an ESOP, in forming an ESOP, there are more parties that will get paid than would get paid in another sale, right? Now, but in total, and this comes down to size, right? If you're a relatively small business, there's certain base level expenses that are just required to set up an ESOP. And so, for a relatively small transaction, I don't know that those would necessarily be any less than you would end up paying to an M&A advisor or business broker for selling that business. But and this comes down to advisor, to the advisor and how incentives are set up around structuring the business. For us, the way we operate our business, we generally operate on largely a fixed fee um, basis for the sale. So, and that fee will vary
Yeah, not
based
like a
on.
sales commission
It's
broker
not
would
necessarily
have.
it's not like we will take 5% of the value of your business when it's
Right.
sold, right? And so particularly as you get up to larger, mid or larger size transactions, just the fact that that's capped can be pretty significant. But in total, like I said, more for you trustee will need to be paid. They'll be paying their valuation agent, which effectively is being paid by the business itself or the business owner. And so all of those things will add up, but in general, they should be, no greater. And again, depending on your advisor and how incentives are structured, can be, significantly less than what you'd be looking at with a traditional sale.
So, Chad, it all goes back to an after-tax basis. It's like it doesn't matter how much money you make; it's how much you save at the end of the year.
Right.
And it's the same applies here.
Yeah.
Yeah. Yep. No, that's excellent. Roger, when we had our prep call for this show, you used this term that an ESOP is the Swiss Army knife of exit strategies. Why do you call it that?
It solves for so many different things. A business owner perceives a bid from a roll-up company and says, "Wow, he goes home and says, "Honey, I really have to think about this." And then in the middle of the night, what occurs to him is, "But I have all these wonderfully valued employees, and what's going to happen to them?" So the ESOP, there's so many different tools within the ESOP to solve for problems like that. Like we talked about when the owner elects to sell and how the governance works. So the patriarch, just with the ESOP, the patriarch can say, "Okay, I want to sell 100% to the ESOP. I want to sell 55. I want to sell whatever the heck it is. I want my children to continue to run their divisions within the company." And the ESOP will solve for that. If you
Right.
sell to a competitor, if you sell
Can't control that.
that
Yeah.
doesn't happen. Yeah.
Yeah. No,
So
that's a great point. I think about that a lot with, these closely held, often family businesses where there are oftentimes some sacred cows and things along those lines that when you sell to a third party, you have absolutely no ability to, to kind of protect what matters most to you as the current owner. So I'm pretty fired up. I'm kind of like ready to do this. Right? You know what I mean? I'm like, yeah, this is awesome. I got a bunch of reasons to do it. Let's look at the other side of this and address circumstances where an ESOP does not make sense. What are, I've already got one, which is you've got debt. I've got another, which is you're trying to wash your hands of this thing. You want away from this company. You don't just want an exit and money, you want to be done. That's another bad, scenario. What are the other circumstances? I'll start with Ethan, and Roger, you can stack on top where an ESOP does not make sense.
Yeah, you've hit two of the biggest ones, right? It comes down to your objectives and the time horizon around those objectives, right? And so if they conflict with what we've described here, then it generally, isn't necessarily going to make sense. There are questions, existing debt or, depending on the nature of the business, again, if there's a lot of uncertainty or sort of lumpiness, right, within revenue and sort of ability going forward, that's going to make it difficult to finance, right, the ESOP up front. Perhaps an outside buyer would be, well, they're going to have the same concerns.
Right.
But you within the ESOP, you're going to have less flexibility in terms of how you finance it. That said, like I said, that's going to be an issue for any buyer of the business. The ESOP does provide options where you could do it without any bank financing, right? And you just say, look, I'm willing to get paid out. I believe the business is going to be profitable enough to pay me off. And you just set it up that way. And there's enough cushion in there that you'll get paid out over time. But again, if that's not a fit with your objectives, it's not going to be a good fit, for the business. Practically speaking, Roger alluded to size, right? I mean, generally speaking, we're saying this works for businesses with, call it at least 1.5 or $2 million in EBITDA, right? Below that level, it's just given some of the fixed costs in setting it up and running it and other things, it can be more difficult, to make it work. The other really critical factor is you need at least 25 to 30 employees. And it's not a specific number, but what it comes down to is the tax benefits they have provided to ESOPs are so great that they've built in what they call anti-abuse provisions, such that we're not setting up an ESOP for Chad, his brother, and his, best friend to reap all that tax benefit. You've got to ultimately end up with ownership of the business spread across a true employee base. And once you get to that 25 to 30 employees, you're generally able to clear those hurdles without, any challenges, so long as they're not all related, because they do actually look across family members. But assuming that, you've got legitimate different owners in there, that works. But below that level, it really may not be the right structure.
Awesome. And just for the audience, where again, I just don't want to take anything for granted. The term EBITDA is pre-tax net profit for simplicity. It's more
Simplicity,
complex
yeah.
than that, but
Yeah.
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 Roger, anything else that you would stack in there in terms of an ESOP isn't going to work for you if?
Well, Ethan did a fantastic job of really hitting on all things. One thing though is a lot of times we forget the owner really has to believe in the business.
Yeah.
Yeah.
They still need the fire in the belly. They do.
This is not, yeah, this is not a thing to do if you're like, man, we're going in the wrong direction and I got to get money out of this thing now. Yeah, because
Yeah.
so much is seller financed.
And you need a good culture because, look, I mean, ultimately, the employees are not going to, they're hopefully going to be excited about what this means for them long term. But it is not like the day after the transaction closes, suddenly, they can turn around and look at a statement with all this value there. This is value that's going to build for them over time. And there needs to be good trust. And again, one of the things I love about this, what I do is we're working with businesses that have a great culture generally to start with. But that in order to really see the benefit from a retention standpoint and ultimately the additional oomph that, being an ESOP and employee ownership can add to the business, you got to be starting with a good culture and good, trust and respect all around.
Nice, nice. And hey, as we close in here on the wrap up of the show, I just want to toss out for all of our live audience. I'm assuming you're just like taking a ton of notes as you're watching this, listening to this. But kind of last call if there's any questions that you want to get answered by Ethan and Roger here, to toss those into the Q&A box now before we wrap. So one of the things, Roger, you said something earlier, made me a little nervous, and I'm not sure if I misheard or if you would expand on this. I'm going to use slightly different terms than you use, but I think you said ESOPs are working better for service contractors than they are for construction contractors, meaning they're working better for companies that have recurring revenue bases and service trucks and things along those lines than they are for a general contractor per se. And that's a little surprising to me, but maybe I misheard it.
Well, it's kind of like you have to have the ability to borrow money, and you need a recurring revenue stream that really you can leverage against and borrow. These service companies, they have right now, many of them.
Yeah.
Exactly. And the ESOP trustee oftentimes may say, you know what, I really value this pipeline. And maybe even the multiple that we're willing to consider would be greater than that of a build to complete. So in other words, sometimes what does a general contractor have to sell? Picture that from the perspective of the lender. So, so right now, those are the ones that are the most attractive are the service companies.
Because they are more bankable. Because they simply put, because banks are willing to put more on the line. But to Ethan's previous point, if I was not bankable, I could still owner finance this whole thing, right, Ethan?
Correct. Yeah, a couple options. You can owner finance it, right? And so you get paid out. And again, if you can, again, there's decisions to be made about, various things. The quicker you can get to being that S corporation owned 100% by the ESOP, it, provides greater, ability to pay that out. So you could receive it. And so that's where it can work well for construction. Another option is actually something called a contributory ESOP, where you're pre-funding the acquisition of shares, right? So over time, you can set up the ESOP, and rather than have it immediately purchase the shares, the company can make contributions to that ESOP, which are completely tax deductible. So you can take all the profit basically for a year or whatever portion you want of it, up to certain limits relative to some IRS rules, and put that into the ESOP and build a balance that then eventually can be used to buy out, to buy the owner. And so you're effectively self-financing it on the front end rather than, having it all through leverage from a bank or seller financing. So there's point being, there are a lot of options that we can work through. And to Roger's point about the Swiss Army knife, depending on the nature of the business and what alternatives might be, that's where this can be really powerful. And one of the things we love doing when it's working through those options with clients. But for construction firms, frankly, just those same issues create challenges for, build to complete or whatever else, create issues for any buyer of the business, right? The ESOP can provide, in some cases, can provide the best, if not only option in terms of those businesses being acquired.
Awesome. Okay. Makes sense. And just to this question of bankability for a second, let's pretend that I'm a general contractor. Average project duration is like 6 months. I'm doing, smaller, types of projects. I'm a $50 million company, and I've been a $50 million company, right? I've got a proven track record of that. Am I a problem from a bankability standpoint, or does that sound pretty good?
No, I think that's feasible. I mean, if you've got good consistency, you've got a good pipeline, they've got visibility on, on the next. I mean, it might be one, it could be 1 to 2 times. Generally speaking, we say banks are going to lend, call it 1 to 2 times, that sort of pre-tax profit. And so again, if you've got good visibility going out 6 months, 12 months in terms of your pipeline, right, the bank who's going to be, looking to lend over 5+ years in the situation you described should be comfortable extending some credit.
Okay, cool. Good. Yeah, all right. So I've got one. I'm scared about what I'm about to do. I've got one hand raised that did not put something into the Q&A, but clearly has a comment or a question. I'm gonna go ahead and invite Helen to chime in here, which is, like I say, a little scary because I hope her microphone works. But Helen, feel free to take yourself off mute.
No need to be scared. I guess it would take me too long to type it, so I just decided to speak. My question is about the fact that you mentioned, Ethan, that is eventually an S corp, right?
Mhm.
So, and then it's an employee-owned company. That means the employees are all shareholders,
Yes, all the
and then
employees are shareholders.
yeah, and then for an S corp to be an S corp, there cannot be more than 100 shareholders.
Yeah.
Okay. So Ethan, thank you, Helen.
Yeah.
That's good. Ethan,
Yeah.
go ahead and expand on
Yeah, I mean, so
the S corp
the
structure.
ESOP is actually, the ESOP is the owner of the shares, and then it owns the shares for the benefit of the
Oh,
underlying employees. And so you don't run into an issue there, and it's really, as I said, it's ultimately one qualified retirement plan that owns the shares.
okay. So
Awesome.
essentially, there's no limit on how many
No, I mean,
employees.
we've done I said, you need at least 25 to 30 really to make it work. We
Yeah.
closed 2 transactions last year where the companies each had more than 1,000 employees.
Okay. Sounds
No
good.
Great.
issue.
Thank you.
Or,
Great question.
like Helen, to that point, like Kiewit is an ESOP and Rosendin is an ESOP. So as Ethan said, there's one owner, the ESOP trust. Everyone owns phantom shares in the ESOP itself. Pat, can I do one thing real quick? And I just want to stress the importance of planning, right? To get to this glide path for the owner that we've talked about, you need to have a plan. You need to start 3, 4, 5 years in advance. And it's not something where you can wake up tomorrow and say, I want to do this. And be the most effective way possible. The planning is absolutely crucial for this scenario.
Awesome. Guys, we've answered so many questions, for the audience, and I genuinely appreciate both of you being here. I as we bump up against time, I'm going to ask each of you to share, if our audience wants to get in touch with you, how should they do that? Roger, I'll start with you.
Sure. My email is Roger, my first name, Roger, Roger, dot Feldman, Feldman, at ubs.com, just to start a conversation. And of course, there's no obligation, no commitment whatsoever when you reach out, and very happy to sign an NDA from day one.
Excellent. Okay, Ethan, if people want to get in touch with you, how would they do it?
Sure. Email is best. It's Ethan, Ethan, .Stambler, STAM as in Mary, B as in boy, LER, at SESESOP.com. Yeah, happy to chat anytime. And if I don't have an answer for you, again, I've got 25 colleagues that are a mix of lawyers and finance folks, and we can definitely get the perspective that you'll need to figure out if this is the right path and what it might look like for you.
Awesome. Thank you both again so much. Thank everybody for tuning in. This has been the Well Built Podcast. I'll talk to you soon.
Thanks, Chad.
Thanks, Chad.